Hello, everybody, and Happy New Year. Today, with our first Learning Lab, ISTAT Learning Lab for 2024, we have Rob Morris from Ascend by Cirium in the studio, and he's going to talk about the outlook and new perspectives on the industry. Now, Rob is head of consultancy at Ascend by Cirium. And they have 9 ISTAT certified appraisers at the company, and they've won a bunch of awards. I can say that personally, I had the privilege to work with Ascend for 35 years. We got quarterly portfolio appraisals from Ascend every quarter. So 140 quarters I had the privilege to receive, and I always enjoy that. Very, very good company, and highly recommended. Now, before Rob joined Ascend, he was with BAE Systems, and he was there responsible for market and strategy analysis in support of lessors and other customers. And Rob also worked at the aerospace team of the UK government's Department of Trade and Industry, where they looked at various projects that they supported for aircraft development and engine developments. Rob started off in 1990 in this industry as a marketing executive for British Aerospace on regional aircraft. So with that, we look forward to your session, Rob, and I hand it over to you.
Thank you, Niels. Yeah, it's good afternoon from London. Good morning to anyone in North America, or good evening if you are joining us from Asia. I'd like to add my Happy New Year to Niels, and I'm going to share my screen, which in the next 45 minutes or so I'm going to use to explain a few things. So new year, new perspectives. And actually, before I start there, thank you, Niels, for that introduction. That's a lot of data. And in these days of big data, analyzing that data is, of course, great fun. So new year, new perspectives. Yeah, don't believe anything that I say over the next 40 minutes. Double check it. But because it's data evidenced, I'll make the point that you can rely on it, really. When I was thinking about, when I was invited to join this session, I was thinking about what I would talk about. And I came up with what I think are going to be 4 key questions, amongst others, that we want to talk about this year. First of all, is demand a slam dunk, to use a sporting vernacular? Do we have to worry about demand risk in 2024? With that, when will supply catch up? We know that supply has been struggling to meet demand for some time, and when do we think that supply might catch up finally with demand, which we'd typically expect around mid-cycle? And then what happens to supply in the longer term? I want to talk about that because I think it's inevitable that when we look at some of the big numbers, we'll talk about at the start of that section, the backlog in particular. I am sure we'll hear people speak about the fact that there is risk in that backlog. We may even hear people talk about order bubbles. I hate the word bubble, by the way, because bubbles can only catastrophically burst. Balloons can go up and come down. But are we in an order balloon or bubble? And then what lies ahead for values and lease rates? Where are we today? And can the positivity we've seen over the last 12 to 18 months continue? So those are my four key questions. Is demand a slam dunk? So if I think about demand and I think about where we've come from and how we've recovered, and I look at purest measure of demand, which is traffic, then the latest numbers that are available, and IATA have been a little bit tardy in publishing the November numbers. I suspect they will come out sometime this afternoon. Actually, they published their freight numbers for November this morning. But looking at the October numbers, they tell us that globally demand, passenger traffic, was recovered to within 2% of the 2019 equivalent in October 2023. The recovery we were craving from April 2020, we've spoken about many times since then, was almost complete. Of course, the markets were bifurcated, and I'll talk about that a bit more when I look at schedule, which is a supply metric to demand. But international recovery was lagging a bit, and specifically Asia Pacific international was lagging a little bit. So international traffic was about 5% behind where it were in October 2019. Sorry, domestic was ahead. So the total market was almost there in October. And if you look at the schedule, and I've used this chart many times, you'll recognize a lot of the charts I use in the next 40 minutes or so, because we use them frequently, because the data is dynamic, it updates. And the scheduled data, a supply surrogate to demand, if you like, that was filed right at the end of last year, shows us that as we get into this quarter and the next quarter, that global capacity will be, by the end of the first quarter, projected 6% up over where it were at the end of the first quarter in 2019. I'd hoped, by the way, this year when I was speaking about the market, that I could stop talking about 2019, but it's just such a useful benchmark to help us understand what's happened in the last few years that I think we are going to talk about it a lot more. But the global capacity marginally exceeded 2019 volumes by the end of last year. In fact, the day kept moving. I remember talking about this a few months ago and saying it was the end of October. There's a bit of a lag in there, and actually we saw the day that our schedule says global capacity exceeded global capacity over the same year in 2019 was the 1st of January. New year, new perspective. If I think about how that annualizes, and looking at IATA's December 2023 outlook, they predicted that 2024 capacity would be 4% up on 2019. If you run the arithmetic, they don't actually make a capacity statement. I think they make a traffic statement, but run the arithmetic with load factor, you get 4% up. And if you look at the accumulated annual improvement over 2019 for 2024, the blue line there, it'll tick up because there's a leap year this year compared to the 2019 number. But at the end of the second quarter, I'm looking to now, end of half year effectively, our numbers say that capacity will be around 5% up over 2019. So very close agreement with that IATA prediction. And in the context of the numbers we're seeing here, whether it be demand, traffic measurements, or capacity, the supply measurement, we're seeing that capacity demand is not going to be an issue this year based on these numbers. And if I look at the very same shape as the first chart I showed you, but look at now capacity, this is for the first quarter of this year, similar sort of trend. If you look at the total domestic markets in the schedule for the first quarter of 2024 compared to the first quarter of 2019, you can see that the markets in domestic terms are 12% up roughly. The international market actually is also, you can't see the line because it's lost in my thick origin line there, but the international market in the first quarter of this year, this is global total international markets, is up 0.1%. But of course the lag is in Asia Pacific, where both Chinese international markets still remain about 15% to 20% down at the end of the first quarter this year. And even intra-Asia Pacific markets, intra-Asia Pacific international markets, so travel from Asia Pacific to China, also still down, meaning that Asia Pacific international is 10% down. The total market itself up by about 6%. So in the context again of the data, we see no issue with demand. I wanted to talk just in the last few slides in this section about yield actually, because we've heard a lot in the last 18 months or so about the increasing cost of travel, driven by inflation, but also driven by supply and demand dynamic and a lack of supply effectively allowing airlines to manage price upwards in the face of constant or increasing demand. So on the left-hand chart, what I'm showing you here from Cirium's DO/FM traffic data is US domestic monthly yield in the green line and the percentage change in the red bar. And we can see that US domestic yield was pretty constant through 2019. And then we saw a significant decline in 2020, unsurprisingly, as supply effectively exceeded demand, as we weren't always able to travel in that domestic market in the US. And then actually significant recoveries and yield being quite significantly up over where it were in 2019. That's on a monthly basis. The right-hand chart is showing you on a smooth 12-month average to remove the seasonality. Yields are obviously very seasonal. In the summer, yields go up. In the winter, yields come down. That's a pretty crass assumption, but it's pretty much how it is. And we can see that if you look at September 2019, the rolling 12 months average to September 2023, yields were up in nominal terms 12%. Capacity was up 7%. So price went up, but capacity didn't go down because price went up, and demand also, traffic was also up. a point we need to remember is that inflation over that period in the US was around 20% total. So actually in real terms, whilst yields were up in nominal terms, they were down in real terms. So yields are going up, but they're not matching inflation. The same chart, I don't need to explain the chart now, for intra-Europe, where yields are also up, but up in real terms less so, only 6% in that September to September change. Capacity was up, but also a bit less up. But you can see that whilst yield cost is going up, demand is not going down, because yield is not going up in real terms. And then finally, the North Atlantic, the transatlantic, the long haul sector, where we know it costs a lot to travel to the US from Europe, or Europe from the US. In the US, actually, you're seeing, of course, exchange rates effects making travel to Europe a bit cheaper. But 12% increase there in the yield, but capacity down a bit, but that's because of recovery of long haul traffic taking longer. It's not about the specifics of the yield. So whilst we hear people talk about yields going up, ticket prices going up, they are not matching inflation, and they are not dampening demand. So that's a pretty quick skate through as demand a slam dunk. I'm going to answer with a few final points. Traffic and capacity recovery did slow marginally in the fourth quarter of 2023. I didn't really talk about that too much on that long term year-over-year chart, but the latter is projected to consistently be above 2019 levels on a global basis through the first half of this year. If I think about why that's slowing, the next section is going to be key to that. Aircraft supply has been a recent key driver to that slowing recovery. Airlines are struggling to find sufficient capacity to meet demand, and therefore demand is being a bit dampened by supply. Asia Pacific continues to lag the global trend. I didn't really talk about this at all, but potential macroeconomic and geopolitical headwinds are still there. They do include inflation. Of course, inflation is slowing. Inflation is slowing probably because the supply side pressures are easing, rather than necessarily the higher interest rates, although higher interest rates are helping. Higher interest rates, of course, will endure for a significant part of this year. We do expect to see some reduction, but not fundamentally significant reduction, maybe 75 basis points reduction this year in the Fed rate. I mean, slowing economies and recessionary pressures. We've been talking about slowing economies and recessionary pressures now for a couple of years, and they didn't particularly exert significant influence last year or the year before. And the continued conflicts in Europe, look at the conflict in Europe is now relatively long term. The conflict in the Middle East is relatively younger, but actually seems set to endure and is seeing effects elsewhere, which will affect supply chains. Slowing economies in China, I haven't mentioned specifically here, but obviously some concerns about the Chinese economy there. But none of those exerted significant influence in 2022 and 2023. We could argue that the recovery we saw from COVID was a key driver to that, the unpenting of demand, but actually towards the end of last year, that was pretty much mature, and it still wasn't exerting significant influence. So don't expect it to exert significant influence this year. Fare and yield increases are slowing now. They're unlikely to dampen demand growth, I would argue, in 2024. In that context, Cirium Ascend is projecting 6% traffic or 5% capacity growth over 2019, or actually in year-over-year terms, 14% traffic growth and 12% capacity growth this year. Seems like a significant bounce back, but I remind you that traffic and capacity was still relatively damp in the first half of last year, as Asia Pacific and China were still slowing its recovery, and Europe also had some impact there. So return back to, if you like, the long-term norm. If we think about the 5% traffic growth over 2019, the cycle is on again. We expect demand not to be an issue this year. So when will supply catch up? Because we know that supply is already fundamentally lagging demand. Just a few data slides here to consider that. The first data slide, of course, is deliveries. And if you look at Airbus and Boeing delivery totals achieved in 2023, and these are provisional because I think Boeing will announce its final numbers on Wednesday of this week and Airbus on Thursday of this week as they play the market share game. But between them, they delivered around 1,200 or so new aircraft, new passenger jets in 2023. if you look at the long-term history, back in 2018, the last now mature year, if you like, before Max and COVID, they delivered around 1,550 aircraft between them in that year. So significantly lower deliveries last year than still. And in fact, this year we're projecting something like 1,500. So still fewer deliveries this year than we had at the peak of the last cycle, effectively. And it's going to take until 2025 before supply chain, engine issues, all those kind of things are fixed, and we see production rates get back to where we expected them to be. How quickly are they recovering? Very quickly. The data that I tend to use to monitor production rates at manufacturers is the first flight. First flight is a physical incarnation of an aircraft rolling off a production line and starting its flight test program before delivery, hopefully a few weeks later. If you look at the data is volatile. This is monthly data on the dotted line and a 6-month rolling average on the solid line. And if you look at where Airbus and Boeing were last year on their A320 and 737 line, Airbus averaged something like 48 first flights, so 48 aircraft built per month in 2023. Boeing averaged about 31 737s, including a handful of 737 NGs, which were being built for defense purposes. But 31 and 48. Now, Airbus have said, by the way, Airbus and Boeing are being increasingly less clear, less transparent in their production planning, because clearly they're struggling to maintain their production plans. But Airbus, we believe, expects to be close to 65 aircraft per month by the end of 2024, averaging 48 last year. You can see they did achieve in excess of 50 in November of last year, but actually regressed back to about 50 in December of last year. So a significant amount of work for Airbus to do if they're going to get to 65. Boeing said, I think quite recently, they expect to be at 42 in the first quarter of this year. 42. They averaged 31, I told you, last year. The trend is currently heading down. They flew less than 20 aircraft in November and just at 22 in December. So right now, the plan, even the plans that are hard to find, but the plans that we're detecting seem to be not being achieved. It seems to be that there is a significant lag still. It's going to take a while for the OEMs to achieve, I think, their desired aims. On the wide body, the issues are less so. On the twin aisles, perhaps less so. Airbus talk about targeting 6 aircraft per month on the A350 in early 2024. They achieved around 4.5 in average last year, but you can see the trend is upwards, and the A350 looks reasonably well set, aside from December's number, when the focus was most likely on delivering aircraft rather than flying new aircraft off the line. And Boeing, well, 5 a month on the 787 is their target, but early this year, currently only at around 2 to 4 on the monthly basis, and averaging last year around 2.5, 2.6, something like that. So again, work to do. The OEMs seem to be lagging their production aspirations. When I think about availability, and I think about what we know the backlogs are sold out for significant time. If you talk to the OEMs, they'll tell you single aisle A320 family sold out through probably 2029, 2030. 737 MAX, pretty similar. There is a handful of, or not a handful, but there's an availability of slots from operating lessors, which might fulfill some near-term demand, if you like. We estimate from our Cirium fleets database that there are around 1,360 open single-aisle slots that have been ordered by operating lessors, which do not yet have a lease identified. Now, in our data, we don't always learn of leases immediately, so this may be an optimistic estimate, and there may be fewer slots available. No slots available, we think, this year. About 1/3 of next year's slots already committed. We've seen 2026 and 2027 commitments. I mean, I think this week, Iceland Air announced a commitment with SMBC Aviation Capital for an A320 and LR delivering in the first quarter of 2026. So we're starting to see those. But there is availability here. This availability is very valuable. This availability is able to leverage relatively higher lease rates for lessors because it is there. What about the used, the stored fleets, if you like? If we think about the stored park, first of all, this is aircraft parked with airlines. This excludes aircraft parked with lessors. I'll deal with that in the next slide. or any aircraft with the OEMs that are pre-built and not yet delivered. The parked inventory of both single and twin aisle aircraft is now down below 2,000. It's pretty close to where it were. It's not quite where it was. It's pretty close to where it were pre-pandemic. I must make the point, this doesn't include about 190 aircraft which in our database were parked yesterday effectively, or parked over the weekend. Max 9 aircraft, where we don't know how long the aircraft will be parked for. Feels pretty short term, but we don't know. So for now, hard to tell what that will do on the capacity and demand balance, but there are not in here now. Of these aircraft, around 300, I'll talk about the PW A320 fleet later, but around 300 of these aircraft are Pratt & Whitney powered A320 neos. In excess of 1,000 of these aircraft are greater than 15 years old. They're midlife and older aircraft. Around 920, that's close to half, have been parked for 2 or more years. So these are aircraft that possibly will not come back into service ever. Aircraft parked for more than 2 years are going to be very difficult to return to service. For 3 years, certainly the grey bars much more. So there's a limited amount of availability within this parked fleet right now. And if I move to operating lease available aircraft, the same trend. I've used this chart a lot in previous presentations, and it's pretty clear that the inventory of aircraft that are offered available for lease, these are aircraft that in our database have been returned to lessors and have no future lease identified, is fundamentally declining, well below where it were at the start of the pandemic. About 175 or so, if I exclude aircraft that are now with Russian lessors that cannot be active in the market, if you like. It's around 50% lower than it were 12 months ago, 60% lower than it were in 2021. A little bit of stability through the winter period when aircraft aren't going back out on lease, but they'll go back out relatively soon. What's in that inventory? Well, the available inventory has a very small handful of newer aircraft. In fact, only less than 60 of these aircraft are less than 15 years old, but I'm not showing you here by age. I'm showing it by commitment. So 175 fully idle aircraft we think could be available, are available. Actually, 40 aircraft or so with a scheduled new lease, 45 aircraft being scheduled for freight conversion, 20 aircraft being scheduled for part out, 20 with Russian lessors. So a real handful of aircraft available here from lessors. And again, this is really quite valuable inventory for lessors, whether it be used or newer aircraft, exerting positive pressure. I mentioned the Pratt & Whitney A320 very briefly a moment ago, but we know that there is the powder metal issue that is still being dealt with, the inspections of aircraft that need need to be, the engines that need to be inspected for potential manufacturing or contamination in the manufactured material. And Pratt & Whitney themselves have said they expect there to be around 350 aircraft on ground from 2024 to 2026 on a rolling average basis, with a peak of around 600 aircraft in the first half of this year. Right now, our data tells us there are in excess of 300 aircraft parked. That's more than 23. It's around 23% of the global installed fleet of Pratt & Whitney GTF powered A320 aircraft. So actually, that 600 odd number, that equates to 3.5% of the global single aisle fleet. That really exacerbates the continued capacity shortage. And if we have 350 or so aircraft on the ground through 2026, that's around 1.5% of the fleet. That's going to exacerbate that position for some time to come. Supply will be fundamentally dislocated by that. What does it all mean? When I ask my question, when will supply catch up with demand? This is the calculation that we do to understand that. And the calculation is pretty simple. What I have here is our prediction of single aisle aircraft and twin aisle aircraft that we expected to be delivered back when we completed our 2021 fleet forecast in the fourth quarter of 2021. By then, we knew what the demand recovery scenario was going to be like. We had a pretty robust traffic forecast, and it's working out pretty well, our scenario 7 plus. And then we look at what are our current projections, our most recent forecast, plus some tweaks for what we know about the production schedule, etc. And the numbers of aircraft we expect to deliver in the period 2023 to 2028 is pretty similar. The green bar and the red bar But if you look at the cumulative delivery delta, we have different phasing of those deliveries. You can see that we have a deficit of A320 and 737 MAX family aircraft, which actually is at its maximum this year. This year is when the capacity shortfall is expected to be at its worst before it starts to improve, but doesn't actually go through parity by 2027 for the A320 family or 2028 and beyond for the 737 MAX. We expect there to be a shortfall in narrow body aircraft capacity through this new delivery deficit through the mid to late part of this decade. Just summarizing that really quickly, when will supply catch up? So, I mean, we expect that OEMs will increase their annual deliveries further this year after they've achieved their targets for last year, but they're still not on target to where they were expecting to be 2 years ago. First flight data suggests that progress is lagging still and it's slow. Lessors have some near-term availability. I've made that clear. They're valuable slots. There's really limited parked aircraft available to return to service now. I usually cover utilization, but if look at the number of hours being flown per day for aircraft in service, they are at the same levels as 2019. So you can't do more with the aircraft you have in service. There are a few aircraft to bring back into service. Lessor used inventory is low. GTF is just going to make things worse. Around 2% of the fleet going to be parked on a rolling average basis through 2026, the global fleet. We expect supply to lag demand for several more years yet. But what happens to supply in the longer term? And here's my point. So if I think about the current backlog or the backlog at the end of last year, these are provisional numbers. I just look at Airbus and Boeing, effectively exclude COMAC and UAC aircraft. The single aisle backlog is around 12,000 at the end of last year, or was. The twin aisle backlog is around 1,800. The single aisle backlog is about 71% of the installed fleet. It's high. It has been higher in ratio terms. At the start of the last cycle, it was close to 80%, 75+% of the fleet was in backlog. That was when the MAX and NEO backlogs were effectively very high at the start of the programs before they were starting to deliver. But the backlog is still very high. And that, I think, might cause people to start to ask questions about, is that backlog appropriate? When is that backlog scheduled for delivery, though? And the really important point is that backlog is scheduled to deliver over a significant period of time, well into the 2030s. There are, okay, it's not fundamentally high numbers of aircraft, but look at that. In 2030, in our database, we have an expectation of delivery of over 1,000 aircraft that are currently on order. In 2031, more than 700. In 2032, around 500. So a significant number of aircraft on order for delivery in the next decade. A couple of points on that, really. I mean, demand is uncertain. Demand is always uncertain. Pretty heroic to order aircraft for delivery back out that far with an expectation of growth. But I'll come on to replacement shortly, because I think it's replacement that means we don't have a bubble or a balloon or whatever I want to call it. The second point is actually pricing and escalation must be uncertain in here. One doesn't know what aircraft values and prices will be. I think we don't know what inflation will be. We're betting on lower inflation now, but there must be an escalation and price risk in there. That's the backlog and its delivery. What about the fleet? Well, the installed fleet in service today has increased in age since 2019, but only by a year. You'd argue, is that significant? Possibly, I think it is, though, because we've had relatively fewer retirements over that period. So that today we have something like 22% of the fleet, nearly 3,000 aircraft, which are greater than or equal to 20 years old. That was 18% at the end of 2019. So you can see how the fleet age profile has marched to the right here at the end 2023 bars by build year, effectively. We've seen more older aircraft staying in service for longer. Actually, there are an additional 270 aircraft not on this chart that have aged 30 years. That was 70 in 2019. So what I think I'm talking to you about here is a potential retirement cycle building up, which, because of the lack of near-term supply, may even build further. Expect average age to increase further before we see these aircraft retire, maybe in the second half of this decade. And if we look at the number of aircraft being delivered for replacement, quite a simple analysis in its purest sense, looking at the total deliveries, the fleet increased, and then working out one over the other to get retirements. You get effectively a replacement ratio that in the first half of this cycle exceeded 50 of the last cycle, sorry, exceeded 50%, and of course ticked up to very high numbers in 2020 and 21. That's a bit of a dislocation based upon the COVID pandemic demand cycle there, but actually saw is currently at low levels. Currently seeing only, well, in last year's deliveries, that was year to date, and I didn't update this actually for the last month of the year. We saw around 45% of deliveries last year for replacement. So although we are in a relatively lower growth, in fact, a recovering growth environment, less than half of deliveries that were being made now were for replacement. So that rolling 10-year average is about 45, 46%, but it could go higher because it did go higher before. In our fleet forecast, I looked at our fleet forecast to work out what we expect to happen in retirement terms in the next 10 years. And in the next 10 years, we expect more than 6,000 single-aisle aircraft to be removed from passenger service. In our forecast, a retirement is a removal from passenger service. The aircraft could be converted to freighter as well as parted out. The single-aisle backlog is now around 12,000. So if we assume those deliveries will occur over the next 10 years, and of course there'll be more because there are still open slots, then I'm saying that I think the replacement ratio will not get up to 50% still. But of course, if demand softens, then we could see more of these aircraft retired at a younger age, and we could see more deliveries for replacement than growth. We have seen that in the past. I just wanted to think about the backlog in the context of specific jurisdictions, and I looked at the countries with the largest backlogs here, and thinking about the backlog to fleet ratio, because backlog to fleet ratio tells us where we need to see high growth for the backlog to be absorbed. And of course, unsurprisingly, the markets where we see high growth required are the markets where currently the backlog is relatively high. India, a market where the backlog to fleet ratio is 3.5. India has a backlog of around 1,750 single aisle aircraft right now. That is 3.5 times the current installed fleet. Unknown, probably there's a lot of Chinese orders in there, so China's got a higher backlog to fleet ratio, but a very high fleet right now, and China will need significant replacement. Therefore, China as a market, even with slower growth, should absorb more aircraft. Malaysia is about AirAsia, and of course AirAsia has a market where it absorbs aircraft into different markets as well. But the higher growth regions are those with, unsurprisingly, the highest backlog to fleet ratios. They will need to see that high growth, and if the high growth doesn't happen, then we might see deferrals of orders in those markets. Less of an issue for the twin aisle, where backlog to fleet ratios are more appropriate. Iran is an outlier because of the orders placed, but the sanctions there that stop the fleet growing effectively. So backlog of twin aisle airplanes is much less of an issue, I would argue. I just want to think about the crossover of Neo to NG, Neo to CO or NG to Max, because that is effectively a way of understanding how we're seeing the next generation airplanes replace current generation. And right now, in our latest forecast, we see that crossover point where the new generation fleet exceeds the current generation fleet, pushing to the right, pushing to the 2026 to 2028 horizon right now, as we see those lower production rates than we might have hypothesized 2, 3, 4 years ago, or pre-pandemic, even higher rates. The crossover point here was much, much earlier than we see today. So that crossover point effectively says, for now, the demand for current generation single aisle aircraft will remain strong, hence the relatively limited inventory of those used aircraft. So when will supply catch up? Well, the OEM or backlog is at an historical high, but it's actually slightly lower than it has been previously as a ratio of the installed fleet. Do expect to hear chatter about further rate increases. I'm surprised. Well, we're hearing some rumors already, but I'm surprised we're not hearing more chatter as OEMs seek to normalize their backlog to few years of production. They need to get to 75, of course, at Airbus, or 57, 58 at Boeing before they can go further. But I think we will start to hear talk of increasing production rates in the latter half of this decade. If demand growth is slower than projected, and right now I don't think demand growth will be a problem this year, we might expect to see more retirements at earlier average ages, of course. India's got that high backlog to fleet ratio I mentioned. That crossover point is 26 to 28. Even if we hear talk of high order numbers, I don't expect to see many order cancellations. The market has changed since I first joined the market in 1990. We used to see lots of cancellations then, but right now we see more deferrals. We only see cancellations when airlines fail or consolidate. So don't expect to see many order cancellations. By the way, I didn't put an order slide in here, but the orders for last year were higher than they've been any year since 2012, I think it was. Don't expect to see many orders this year either, although I think we've already seen the first order for EVA Air firming up some Airbus orders earlier today, but don't expect to see many orders either this year. And do expect to see the vast majority of these aircraft that are in backlog now and potentially more delivered, but over a significantly longer horizon into the 2030s and beyond. Finally, what lies ahead for values and lease rates? I'll go pretty quickly. Before I go into the numbers themselves, I just want to remind us what drives values and lease rates. Demand and supply, or the balance thereof, are the key drivers of aircraft values and lease rates. This is a chart we use frequently to explain to our clients in the market what really drives aircraft values particularly. But the bottom two, the macroeconomic factors, are demand. The industry-specific factors are supply side factors, capacity in the market, the stored fleet size, etc. So demand and supply are the two key things that exert pressure on values and lease rates. We can talk about interest rates. They exert some pressure. We'd like them to exert more pressure from the supply side, but actually they don't really have that much control because it's about demand and supply. When I think about that, before I dive into the numbers, finally, I wanted to talk about market sentiment as well. We use something at Cirium Ascend called the Cirium Ascend Commercial Aircraft Market Sentiment Index, CAMSI. I'll refer to CAMSI from now on. CAMSI is a survey that asks market participants how they feel about our market values and lease rates, both the quantum and the trend. And since we launched this survey back in April 2021, we've seen a strong and positive market sentiment, but actually we've seen a stable positive view through most of 2023. If I think about what our survey says, our survey seems to say that most people think that there is limited upside headroom in market values and market lease rates from the middle of last year. What do we think? Well, I think we might think a little bit differently, actually. If I think about where our singular market to base value ratio is, market to base value ratio is a great indicator of supply and demand. And in the perfect market would wander around base, being 50% below base and 50% above base in a perfect cycle. Of course, cycles are imperfect, so that isn't the reality. But currently, the market value to base value relationship for single aisles is close to 120%, close to 1.2. That's higher than it were at any point in the last cycle, driven by effectively market recovery revisions. And then actually the twin aisle market, which, as I'll show you on the next slide, was below base for the entirety of the last cycle, is actually accelerating significantly now above base. Market value changes in the fourth quarter of last year are a key driver to that. And actually in January 2024, it's about base value revisions, where our base value curve is slightly steeper than our market value curve when it comes to inflation or deflation, depreciation. And that's what's driving the slight uptick in January 24. But market value is mainly the driver to that. Longer term, as I alluded to this, longer term, you can see single aisle market is higher as a ratio of base than it's ever been. And frankly, in this last cycle, which was the fundamentally most impactful demand cycle ever, when 2/3 of demand were lost in 2020, we didn't see market values decline as fundamentally relative to base as they did in the 2001 cycle or in the 2009-10 cycle, post 2008, because supply was corrected very quickly. Supply was corrected so quickly that we now have a supply side issue, as I alluded to earlier, which is driving the strength. For once, the OEMs have helped us in value and lease rate terms. But there is more headroom. And why do I think there is more headroom? Or more importantly, why does George Dimitrov, our head of valuations, who knows a lot more about values than I do, think we have more headroom? That is because on a fleet weighted average basis, we do not see, for some types, market values recovered yet back to where they were pre-pandemic. So what I'm showing you here is the green, the market value change over the last 12 months, yellow, the market value change over the last 24 months, and red over 48 months. These were in mid-December. There are some types, and the types are typically the more more marginalized single aisle members, so the 319, the 737-700, but also the 321-200 Sharklet, the 320-200 Sharklet, where market values are not yet back to where they were in 2021. Oh, sorry, 2019. So more headroom, we think, for improvement. But for twin aisles, the position is even more stark, actually. For the A330, for the 787, in fact, the only type that has market values recovered to where they were 4 years ago is the A350-900. You can just about see it there above the origin line. So still more headroom for improvement in market values, we believe here. And the same for lease rates, frankly. The lease rate chart is very similar to the market value chart for single aisles, with a few types still waiting to see recovery back to where they were, excuse me, in 2019. And likewise, the same for twin aisle. So to summarize that, what lies ahead for values and lease rates, I've pretty much made myself clear, I think. Our sentiment survey is positive but stable. It does suggest we think that the audience believes there is further positive potential. The further positive potential, sorry, is limited. The significant changes we saw last year have taken market above base and to the highest levels we've actually seen since 2000. Actually, Niels did ask me, did we plot this chart back before 2000? And we haven't really done so because we're not fully confident in the data that allow us to do that. Several types, though, have not seen those values of lease rates recover back to those 2019 levels yet on that fleet weighted average constant age basis. And that is why we believe there is further headroom, because the supply and demand dynamics are set to remain favorable for values and lease rates for some time yet to come. And hence, there is more headroom for positive increases, we believe, this year. To conclude the entire presentation in 4 bullets, as I've answered each of my 4 questions in these bold statements here, demand risk feels and looks limited in 2024. A very bold statement to make. We'll continue to monitor and watch all of those demand risks, but it feels limited, and demand should be a slam dunk. Supply is expected to remain lower than demand through 2026 at least. The OEMs have a lot of work to do to continue to increase production rates. There are supply side issues. I haven't even spoken about the MAX 9. That's a very unknown issue right now. Thus, I can't understand what it does for supply, but we'll see how that evolves over the next few days and weeks. Longer term supply is dependent upon the demand dynamic. I didn't talk about demand risk in the mid to latter part of this cycle, but replacement demand is increasing. And so we may see a higher element of replacement in the latter part of this cycle if sustainability arguments or economics or geopolitics do dampen growth and bring growth below what we expect in this cycle. And by the way, I didn't talk about what our fleet forecast prediction is. There is a fleet forecast webinar from a Cirium consultancy in a couple of weeks' time, where a couple of my colleagues, Richard Evans and Chris Seymour, will talk about the fleet forecast and explain our growth assumption. Our growth assumption, frankly, is relatively conservative. We don't expect to see high growth in this cycle compared to the last cycle, when we saw that 6 to 7% growth compound annual over 10 years. And there is headroom for further positive values and lease rate movements in 2024. Thank you for listening. Thank you for ISTAT for giving me the time to explain these points to you. I'm going to hand back now to Niels, where I think we're going to have a little Q&A session for the next 20 minutes or so. Niels, thank you, and back to you.
Thank you so much, Rob. This was extremely interesting, as usual. Now, I screwed up in my introduction because I should have mentioned to the audience that you can write in questions by clicking on the little Q&A button at the bottom and write in your questions, and then I will go over those with Rob to the extent we have time. Now, that did not stop Mary Prettyman, who is the reigning president of ISTAT, to post a question, because she knows the ropes here. So Mary is asking the following question. Are persistently high interest rates and high escalation going to influence fleet retirement and replacement as ownership costs of new assets are driven higher?
That's a really good question. So I think that we are seeing to some extent the higher interest rates feeding through to higher lease rates. But if I think about lease rates, or indeed cost of ownership in the entire airline operating cost pie, then they're relatively, they're not insignificant. They're not that significant. You know, fuel is the most significant, clearly. Labor is clearly significant, and labor increases are possibly higher right now than ownership cost increases. We've got maintenance cost increases as well. So I'm not sure that I see the ownership element of that pie growing fundamentally ahead of any other part of that pie. So as a consequence, I mean, George has said this in public several times. If airlines had to pay more for aircraft, now is the environment within which they have to pay more for aircraft, and they could, because they have also been able to increase yield, as I said at the start of the presentation, albeit not by as much as inflation. So I'm not sure that higher prices, higher lease rates, driven by higher interest rates, will drive through to significantly higher ownership costs relative to other costs that airlines have to bear, and consequently, I don't think they dampen the growth. I think there's another point as well to make, Niels, which is Mary, which is my point about fuel being the most expensive part of the operating cost for an airline. Something like, I can't remember the number, it's 23 or 24% of operating cost last year was fuel, according to IATA. Replacement with more fuel efficient aircraft burning 15+% less fuel does affect that that operating cost pie and bring the cost of fuel down, and also the cost of CO2 down, because there'll be a CO2 cost there as well. So there's a balance in that. You know, we'll pay a bit more for a new aircraft, but we'll pay a bit less for the fuel as a consequence, or the CO2 as a consequence. So I'm not sure that I think that higher costs will have a dampening effect on demand for new aircraft.
Okay, thank you for that. So while you all type in your questions in the Q&A button, I have a few questions that I want to bring up with Rob. The first one on the traffic numbers. Are you getting reliable traffic data from the Russian air traffic?
So in our schedule, we are still getting scheduled data from Russia. Actually, in our forecast this year, we removed Russia from part of our forecast. We're not confident in the longer term numbers. But yes, for now, Niels, the numbers we have in the schedule seem to be reliable. I mean, I didn't include the data, but the best data set that I think right now for understanding what's happening in Russia is tracking.
Yes,
Cirium has the tracking data, yeah. and we have the Aerion. You know, we have the type with Aerion now, which allows us to receive data that is being used for air traffic control purposes. So it's reliable data, and we process that data and feed it back into our tracking data, and that does give us a good picture of what's happening in Russia. If I'm honest, I haven't looked at it recently. I can't comment on it because I haven't looked at it recently. But that data is the most reliable data to use for Russia right now.
But does it look like they still have aircraft that they can fly?
Yes, it does. From when I last looked, yes, it does. And it's interesting, actually, when we were waiting for this learning lab to start, we were listening to the ISTAT video, or watching the ISTAT video, and I happened to look at my phone, and I do use the platform formerly known as Twitter as a source of news, and I see Flight Global reporting another runway overrun in Russia. I don't know what the cause of that runway overrun is, but that's the second runway overrun in the last couple of months, I think. So you know, we expected when the Russian situation began that reliability would become an issue if sanctions were effective. Clearly, it doesn't appear to be a significant issue. Sanctions are potentially not effective, but it must be the fact that reliability, maintenance, surely it must be the fact becomes less reliable with time. We just don't know how to detect that. Yeah. But for now, the fleet looks like it is, yeah, still significant.
Yeah. In your answer to Mary Prettyman, you mentioned that you know, there is a pull for fuel efficient aircraft. Now, do you see any signs that the sustainability issues and the maybe a reluctance to bet on current technology aircrafts in order placements, that this is going to have an effect on the deliveries going forward?
I mean, potentially, because I talked about sustainability and fuel efficiency and how that's an incentive toward a new aircraft, but we know that the reliability challenges that the current, maybe let's call the current production aircraft current generation, but the current generation aircraft have significant reliability challenges right now. You know, both the GTF engine and to some extent the LEAP engine have reliability challenge and also maintenance cost challenge, which is making the operation of those airplanes potentially uncertain, the cost of operation of the airplanes potentially uncertain. And to some extent, that has caused airlines to think about retention of, let's now call them prior generation NG and CO, because they're robust and understood. But of course, the CO and NG fleet is finite and aging. Hence my chart, which shows the crossover point, because we can only maintain CO and NG in service for so long. Okay, we don't have age restrictions in quite the same way we had perhaps in the early 2000s or early 2010s, but they are still there to some extent. And the reality is that older aircraft have lower reliability because they need more maintenance. That's just a reality. Of course, they have understood cost, but I think we need to get through the current period of where reliability and maintenance cost of current generation, Neo and Max, are not so well understood, to a point where the next generation of engines or the next iteration of engines on those become more reliable, become better understood in maintenance cost terms. And then that's, by the way, the time 2026, 2027, when my delivery projections also increase further, when the supply chain challenge is also fixed and we see more new aircraft being delivered, people become more confident in them again. So the back end of this decade, by definition, that means the back end of this decade is also the time when investors in CO and NG should be thinking about the longevity of their investment. They probably have had their return or the first investors have had their return, but midlife and older aircraft in passenger service also become a little bit more risky, if you like.
Yeah. Rob, there are, I think, 3 C919s flying in commercial operation in China now. Have you started to count the COMAC products into your capacity forecasts, and how do you see that play out in the next 5 years or so?
So I think there was one delivered in 2022. There were 2 delivered in 2023. There was 1 delivered on the first day of 2024. So there are 4 delivered now, but I'm not sure the fourth is in service, Niels. But yeah. So I specifically excluded them from the charts I showed, but our fleet forecast does specifically include them. And if I think about the forecast of C919 deliveries in China, they probably capture something like 20% of the market in China over the next 20 years. If I think about what that means in global terms, it's maybe 5% or less. I think about the MS-21, by the way, in Russia as well, the same way, a very, very niche product. The impact of that product in the market effectively is driven by the ambition or aspiration of the OEM. And if I think about the aspiration of the OEM, what COMAC have talked about, I believe, in public, and I'm pretty sure these numbers are correct, they've talked about potentially building a maximum of 10 aircraft a month, 120 aircraft a year. 120 aircraft a year. I mean, I wouldn't be surprised if I hear Airbus in 5 years' time talking about something like that number a month. I don't think they'll get to 120. Don't quote me on that, but I think they'll be talking about building 80 or 90 aircraft a month by then. So get 3/4 of COMAC's ambition for the year. That pretty much tells us everything. And the other point is, think about what it took Airbus to become a market player. The commercial innovation that Airbus had to make to force the A300 into the market, the commercial innovation and support the A320 had to have from European governments and European stakeholders, airlines, etc. That took Airbus from 1987 to today to establish the A320 as the market leader of what it was, and not to today because it's been the market leader for many years. But that's how long it could take COMAC if they have the ambition, if they have the support. I'm sure they have the ambition. I'm sure they have the support, but it's going to take a long time.
What is the CMV for a C919 today? To ascend.
You put me on the spot, and I can't remember the number, but it's significantly lower than the A320 or 737 Max CMV.
You would give me one if I asked for it?
I think we've got a number. Yeah, we do have a number, and it tends to be the sum of the 2 engines.
Okay.
And actually, Neil's the point there is CMV, right? What it's about the definition. CMV is about liquidity, isn't it?
Yeah.
I showed that pyramid of value. It's about liquidity, and actually establishing a robust current market value number would require us to understand a global liquidity of an asset trading in US dollars.
Yeah. Yeah. Now, looking at the chart with the backlog to fleet size for different countries, there were a couple of countries that stuck out there. Do you find that the ratio in India is a rational ratio? Is it?
So when I first looked, I mean, I think there's a high risk in that number because it requires very high growth rates to achieve it. But I think about, I remember looking at this many years ago when I was looking at backlog to fleet ratios for Indonesia and Malaysia in the context of AirAsia and Lion Air, and I looked at I looked at some benchmarks in Europe, Ryanair and EasyJet, and kind of went, oh, I could match Lion Air to Ryanair, and I could match AirAsia to EasyJet in their required growth rates. But that required, the growth rates that Ryanair and EasyJet were able to achieve to absorb their own backlogs were driven by a fundamental shift in the market from network carriers to low-cost carriers by deriving very low fare, etc., a market share shift. And by the way, also stimulating growth even in those mature markets. So we need to see that in India now. India is a market that has a geography that's, well, I'll compare India to China actually, because I looked at Chinese growth rates. So China was able to achieve very high growth rates in the last cycle and absorb a very significant fleet of airplanes to become a big part of the market. India's got similar population but smaller geography and some infrastructure challenges that China was able to overcome, because in China, you want to build an airport, you build an airport. The money's there, the will is there. In India, we have to see infrastructure challenge overcome. We have to see a market that has had a yield profile that really wasn't appropriate to the cost profile, hence the number of bankruptcies you've seen in India, because airlines were not able to make money in India. We need to see the competitive dynamic change, and I think the Air India change of ownership could allow that to happen. But it still feels like that backlog is very high, and the backlog for India, the one sort of mitigating factor, I suppose, is it does stretch out a long time. There are aircraft on order in India for delivery in 2035, 11 years hence. The issue there is that's about replacement. Think about Indigo and how Indigo has managed its fleet with, we order lots of airplanes, we do the sale leasebacks, we do 6 or 8 year leases, we return them before we do the first heavy check, and therefore we can absorb aircraft on a much higher backlog to fleet ratio than others could. I think that's now changing a little bit. I think there's some change going on because of the technical issues they're facing right now. But I think they'll try and revert to that. But I'm not sure that market can absorb all those aircraft. We'll see. So it feels high risk to me.
Okay. We have a question from Karen Berg. She's saying, if operators are going to hold onto their NG era aircraft, due to the unreliability of the new, some of the new engines, what is that going to do to the passenger to freighter feedstock pipeline?
That's a really good question. So the passenger to freighter feedstock pipeline was at a record high probably 12 to 18 months ago. A lot of aircraft, whether it be 330 or more interestingly A321 or 737-800 were placed into that backlog, because also demand for those aircraft was significantly higher, or expected to be significantly higher at that time. But we have seen even now some aircraft being pulled out of that backlog and seeing leases extended. So it will mean that some of that feedstock will be pushed out to the right, perhaps. But I made my point. If I looked at my leasing slide I showed you, the leasing inventory slide, there were 175 single-aisle aircraft available. There were 44 single-aisle aircraft on that chart that were committed for P2F already, in our understanding. There were only 35 committed to new leases. So still the balance between new lease and P2F is higher towards P2F. So there'll be some feedstock that is deferred a bit, I think. But that can't go on forever, because because the NG and CO fleet can only continue to age for so long in passenger service before it does need replacing. Before, you know, how many airlines will say, I'll do a next check, but not the next one after that. So I'll do another 6 years or another 8 years. And so I think in the back end of this decade, that's when we might see significant numbers of feedstock arrive. I still think there'll be conversions because people have committed, or people have made the case that it makes sense to just convert the airplane anyway. We've kept the reserves. We'll put it into the conversion, use the reserve for that, etc. So I think it defers some of that conversion, but not a fundamental. And I haven't got the slide in the deck, but we do have a P2F conversion forecast as part of the fleet forecast that Chris and Richard will talk about in a couple of weeks' time.
Okay, thank you. So Mary is back with another interesting question that is kind of related to capacity, but not aircraft capacity, but pilot capacity. She's asking, do you think that the pilot shortage challenge is being adequately addressed, for example, through various efforts to expand opportunities and training?
That's a good one. It's one that I'm not really that expert in, Niels, but I've got a few comments, I think. So I think we are conscious of the pilot shortage. We are trying to deal with it through various initiatives. Through, you know, if you look at it, particularly in the US, where you see partnerships between majors and regionals and even, you know, cargo airlines, where we're trying to feed a pipeline of new pilot in. But I think there is a risk there because, if I think back to when I was coming out of university, you know, being a pilot was seen as a relatively attractive, well-paid, interesting and glamorous profession. I think there are more interesting and glamorous professions today than being a pilot. So I think there is a risk,
right?
Yeah. I think there is a risk that we don't see sufficient human capital. It's not just pilots, actually, engineers as well. It's, you know, maintenance. I won't comment much on Boeing, but maybe what's happening at Boeing is a consequence of the engineering profession not being what it once were. So I think there is a risk in there. Yes, I think Mary's got a good point. I don't know too much about that, though, sadly.
Yeah. Fiona Cockland is asking, how do you expect the recent news on the 737-9 groundings to affect Boeing's delivery schedule over the coming months/years?
Yeah, that's one I can comment on, because I looked at the numbers yesterday. So actually, if this cloud has a silver lining for Boeing, it's that only about 5% of their scheduled deliveries this year are MAX 9s. So relatively fewer of the deliveries that we expect this year from them will be MAX 9s. Now, I don't know, of course, what the FAA findings or the findings of those inspections means in the context of what FAA might then consider next for oversight of deliveries, and if that does have an impact on other aircraft in the Boeing, other MAX variants. So I suppose in the number terms, it looks relatively small scale. In risk terms, hard to say right now, but there must be downside risk on Boeing's number for this year as a consequence of this, as there were downside risk last year with the 737 tail bolt issue or the 787 skim issue, etc. So it does feel like there could be downside risk for Boeing's numbers this year, but too early to know what that would be and quantify it.
Yeah. All right. That's there's another question that just came in. Let's see. It's from Eleanor Lillamar at Novus Aviation in Dubai. She's asking, how long will the shortage of twin aisle aircraft persist in Cirium's views?
So
they've only showed single aisle.
Yeah, I know, and I'll Eleanor, I'll share that chart with you afterwards and add the twin aisle. But it persists for a little less long, and in fact the issue is also not so great. So there is a deficit, but the deficit is far smaller for the A350. There is a deficit for the 787 that is slightly greater because of the rephasing, because of the delays in deliveries last year, and we think they'll be absorbed this year. So it probably gets fixed in 2025 or 2026, but I'll calculate the numbers and share the chart with Eleanor specifically.
Okay. Rob, thank you very much. I'm happy to hear that the news this time is much better than the news last time you did a learning lab. When was that? Was it in 22? You did
Thank you, Niels. It might have been in 21 even, or 22.
Okay.
Yeah, certainly. So, you know, as I said in Dublin last year, I can see clearly now the rain has gone. Well, I can't, the clouds came back. I can't see quite so clearly now, but I do think that in demand terms, we don't have anything to, you know, there are always risks, but I think the risks are you know, are less. I think the supply side, this cycle is very different because the supply side issues are just making for such interesting analysis, if I can put it that way, as an observer. And that supply side issue could go on for a long time to come yet.
Yeah. But you know, I liked your comment about the bubbles burst, but balloons go up and down.
Yeah.
And I think you can also say that what comes down must go up. And I think
Yeah.
that's true now, right?
Of course, Niels, that'll be the question for the next learning lab in 2 years' time or whatever, because values will have gone up and up and up, and then what goes up must come down.
Yeah. Yeah.
But not for a while yet.
Okay, thank you very much, Rob. Now, interesting segue into the next thing I'm going to bring up is that the 6 questions we had today were all from women, and that's very appropriate because next Tuesday at the same time we have a learning lab that is a special edition learning lab where we're going to have the ISTAT Diversity, Equity, and Inclusion Award recipient, SMBC, do a lab. So call in for that. And thank you so much for listening in today. Thank you, Rob. And see you next Tuesday, same time. Bye-bye.